Good afternoon to our audience, both on site and those that are attending with us virtually. I'd like to welcome you to this masterclass, and I look forward to the insights that Imtiaz will provide us with. Imtiaz Mohammed Alli is the Smart Beta Portfolio Manager at Momentum Investments. He started his career in the industry in 1996 at ABSA Consultants and Actuaries. In 2000, he joined the Momentum Group in the wealth business as a unit trust dealer. He moved into Momentum Investments in 2004 and started co-managing investment portfolios, including absolute return funds from 2008. In 2011, his role expanded to include tracker fund management as well. Imtiaz has a commerce qualification from one of the leading universities in our country. Welcome, Imtiaz. I look forward to hearing from you.
And welcome everybody to the Smart Beta presentation today. So in April of 2017, as part of the systematic strategies team, we launched 2 Smart Beta unit trusts. The first being the Momentum Trending Equity Fund, which is based on the momentum factor. And the second was the Value Equity Fund, which, as the name suggests, based on the value factor. And in August of this year, we launched our third unit trust, which is the Momentum Quality Fund. So what is Smart Beta? Some of you might have heard of this term before and some of you not. However, it's becoming more and more prevalent in recent times. So a good starting point for today's presentation, I will look at the different indices out there. So the first index I will look at, for example, is the market cap weighted index. Then we will also look at the equally weighted index as well as the price weighted index. From then on, I will go into active versus passive management. Now, with regards to active versus passive management, in terms of which one is better, will always be around. However, for today's presentation, I will look at assets under management as well as flows. From then on, I will go into the concept of Smart Beta. Now, within Smart Beta, there are different factors that one can invest in. And the most common factors, and those are the ones I will be going through, are the momentum factor, the value, the quality, and the low volatility. And then within the Smart Beta space, you also have the multi-factor approach, which I will also touch on. We will look at the growth of the Smart Beta market in terms of how it's been growing. And as with any investment, performance is quite important, so we'll touch on the performance on some of these funds. And also look at the fees in terms of where Smart Beta fits in compared to your active managed funds and compared to passive funds. So I hope today's presentation will give you some valuable insight into the world of Smart Beta. So moving on to the indices. The first index I want to speak about is the market cap weighted index. Now, this index weights shares according to their market capitalization. So basically, a share with a higher market capitalization will have a higher weighting in the index compared to a share with a lower market cap, which will have a lower weighting. Now, the one downside of this methodology is that you'll find that you could have a share that is overvalued. However, because it has a higher market cap, its weighting in the index will be elevated. And the same with a share which is undervalued. If it has a low market cap, it will have a lower weighting in the index. Now, having 1 or 2 shares which might be either overvalued and have a higher weighting in the index might not be that much of an issue. The real issue comes in when you have an entire sector which could be overvalued and have an overweight in the index. Now, an example of this, if you look at the dot-com bubble of 2000, you'll find that the technology shares had quite a hard run. And as the share prices were increasing, obviously it's having an impact on the market capitalization. So the weights in the market cap indices of technology shares would have been quite high. Now, as an investor, had you purchased the index itself, your weighting towards the technology shares would have maybe been higher than what you would have preferred. And when the market crashed, obviously, investors lost quite a bit of money. So that's the market cap weighted index. The other index I want to speak about is the price weighted index. Although this index is not that common, one of the indices that still uses this methodology is the Dow Jones Industrial Index. And they started this index in 1896. Now, when they started this index, it was seen as a simple way to track the performance of the market. However, at that point in time, there were only around 12 shares listed on the exchange. But it's, in terms of downside, it's a similar downside as that as your market cap weighted index, in that shares are not weighted according to any fundamental basis, but purely based on either share price or market capitalization. That brings me to the equally weighted index. Now, over time, what investors realized is that your small cap shares would at certain times outperform large cap shares. And this brought about the equally weighted index. Now, with the equally weighted index, because shares are equally weighted, you'll find that over time, the index needs to be rebalanced. And the turnover of such an index can be quite high and add to the cost of the portfolio. And obviously with cost impacts your performance. And then also, because small cap shares are upweighted within an equally weighted index, the possibility of having illiquid shares to rebalance also poses a potential issue. Now, as an investor, whether you invest in the market cap weighted index, the equally weighted index, basically that's your passive investments, where you buy and you hold the index and that's it. The other option is to invest with a portfolio manager. That's basically your active management. Now, in terms of the differences between passive versus active management, just to go into that. So with your passive portfolios, the investor knows what type of return they're going to be getting. And by that, what I mean is you're basically getting the return of the market. However, I must add that obviously there would be a slight lag due to fees as well as rebalancing cost. However, speaking about fees, the fees on passive funds are much lower than that compared to your active managed portfolios. And then we know that not all active managers manage to outperform the benchmark. So for that reason, investing in a passive fund will probably outperform some of the active funds out there. Looking at your active management. So the portfolio manager would aim to outperform the benchmark. However, this is not guaranteed. Then with the portfolio manager, a lot of detailed research goes into analyzing companies, and the portfolio manager would probably have a team behind him, which where they do investment analysts. They would go to company presentations or site visits, etc. Now, what you find, there's a cost behind all of this, and that cost needs to be allocated somewhere. And that's the reason you find active funds have a higher pricing compared to your index funds. Now, the one benefit with an active portfolio management is, as a portfolio manager does research, you find that he could find certain shares which are deeply undervalued. And you can immediately start adding that to the portfolio. However, that's not possible with passive investments. So where has the money been moving into? On my next chart, this is the growth rate of exchange traded funds, basically your passive investments. So for the last 10 years, the passive market has been growing by around 24% per annum. So that is quite a strong growth rate. So what are the drivers behind this growth? Firstly, not all active funds are managed to outperform the benchmark. So there was research done by the Dow Jones Industrial Index. And what they found was that for the period, 15-year period ending December 2016, 90% of large cap, mid cap, and small cap fund managers failed to outperform the S&P 500. Then there's also the question of fees. Fees on passive funds are much lower than that of your active managed portfolios. Now, maybe we can skip this question. I thought there might be more people in the crowd. But if the passive market is growing quite strongly, what would you think the growth is between, or the split between active and passive funds? in terms of assets under management. So here you can see the growth in terms of your passive market has been quite strong. However, if you look at cumulative flows into your active funds, that has been static to slightly down. Now, looking at this chart, one would think that the passive market is obviously, as a percentage of assets under management, would be quite large. However, if you look at active funds under management compared to your passive funds, your active funds are still the majority of the market. Now, why is this? This speaks to the point that investors either need or want to outperform the benchmark. And at the same time, if you look at the chart on the other side of the graph, you'll see that the growth of the passive market is quite strong. Now, the reason for this is investors want to pay a lower fee. Now, putting this together, investors want to pay a lower fee and they want to outperform the benchmark. So how do you do that? And this is where smart beta comes into the picture. Now, smart beta can be known as strategic beta, or it can be known as factor investing. However, this concept has been around since the 1970s. But the first smart beta ETF was only launched in early 2000. And the term was coined by a multinational research company called Towers Watson. And what they indicated was that an investment should have 4 basic characteristics. It should be simple, it should be transparent, it should have low fees, and a systematic methodology. Now let's look at smart beta from those characteristics. Firstly, with regards to simplicity. So smart beta funds are simple and easy to understand. So as an investor, if you choose a certain factor, like a value factor, you know what goes into creating that fund, and you know the objective of the fund. In terms of your transparency, looking at a smart beta index, the shares, you can see what shares are in the index, and you can see the weightings of those shares. That will speak to transparency. We know smart beta fees are lower than your active managed funds. And in terms of systematic methodology, smart beta funds follows a rules-based approach for selecting shares. Now, because shares are weighted according to certain investment styles, you'll find that the risk of having an overvalued share with a high weighting, as I mentioned in the cap-weighted index, that risk is basically eliminated. So where does smart beta come in? So smart beta gives the investor the benefit of both worlds. Firstly, in terms of your active management, smart beta gives you a low fee with the benefit to outperform the benchmark as well. Now, besides this benefit where you can outperform the benchmark and pay a lower fee, which I might add is obviously important, there's a third benefit, and that comes in with diversification. So diversification to a smart beta product will further reduce your risk, but then within the smart beta space itself, there are different factors which one can invest in. So so in terms of diversification, you get that benefit as well. So how has the adoption rate been for smart beta funds? Now, there was a research done by FTSE Russell, where they surveyed global asset managers managing over $10 trillion of assets. And the question was, do you have or do you intend to have smart beta as part of your investment strategy? Now, in 2014, when they started the survey, around 30% of respondents said that they preferred to have an investment or either had an investment towards a smart beta strategy. However, in 2018, that response rate had gone up to 50%. Then what was the other interesting thing about the survey was that one of the questions was, do you not intend to invest in a smart beta product? And 25% of respondents said they don't have an investment towards smart beta and they don't intend to invest in smart beta. And that was in 2014. However, in 2018, that had dropped to 9%. So that tells you that in 2014, the respondents, some of them, which mentioned that they would not invest in smart beta, probably done some research and found that it's actually a viable approach as well. And that is why that response rate has dropped from 25% to around 9%. And then some further evidence in terms of the growth of the smart beta market. So even though it was launched only in early 2000, there are currently around 1,200 smart beta ETFs on the US market, and with total assets under management of around $1.5 trillion. Now, we've seen earlier that the growth of passive funds has been quite strong. So for the last 5 years, growth into cap-weighted funds has been growing at around 21% per annum. However, when you look at the smart beta funds, growth has been at 32%. So clearly growth towards smart beta products outpacing those of your cap-weighted funds. Now, in terms of the share of the smart beta, the ETF market, smart beta funds in 2010 had 14% of the total ETF market. However, in 2018, that had grown to 21% of the total ETF market. So clearly the demand for smart beta is picking up and is growing quite strongly. Now, I mentioned that within smart beta there are different factors. So firstly, why do these factors exist? Now, there's different schools of thought out there and there's different reasonings. So I'll just go through some of them. So firstly, one of the reasons are that there's a risk premium attached to these factors. So investors are rewarded for the risk that they take. Now, looking at a value share for an example, you'll find that value shares could be cheap for a reason. And over time, you would expect them to outperform more expensive shares. However, they could be cheap for a very long time. And for example, if there's a recession, it's possible that the value shares could be the first to be hit. So for this reason, there's a premium attached to the risk premium. Then there's also those who believe in the behavioral bias, where strong shares with good growth prospects are chosen and basically value shares are maybe overlooked. Then there could also be a structural issue, like liquidity, for example, which could create some factors where one can benefit from. So, however, one cannot say with certainty what are the exact reasons for the factors existing in the market. However, looking at the momentum factor now, so the momentum factor is based, you probably heard of the term, the trend is your friend. Now, it's based on the fact that shares which have performed well in the past will continue to perform well in the coming months. Now, portfolio managers would typically look at the last 3 to 12 months performance. So does a momentum factor actually work? Now, there was a 1993 study done in the Journal of Finance where they looked at the US market from 1965 to 1989. And they found that the momentum premium generated significantly higher returns than the overall market. Now, further to that study, there were other studies done as well, which showed that besides the US market, this factor also worked in the UK market as well as in emerging markets. Then we have the value factor. So the value factor has been around for quite a while. And basically, we look at shares which have certain value attributes, like, for example, your price to books, price to earnings, dividend yields, and free cash flow yields. Then we also have the quality factor. Well, the quality factor, basically it's shares which have a strong balance sheet, higher industry margins, as well as a higher return on equity. Now, with quality funds, you'll find that they are much more stronger to weather any downturn. And for this reason, you'll find over long periods of time, they would outperform the market. Then we have the low volatility factor. Now, with the low volatility factor, it's basically shares which have a lower volatility compared to the rest of the market. Now, one of the characteristics of a low volatility share is that you'll find in terms of performance, it would basically give you the performance of the market. However, the one benefit is it doesn't participate in the downside as much as the rest of the market. And that's where you get your benefit in terms of a long-term horizon. So one thing to mention with all these factors is that they basically would perform in certain investment cycles or economic cycles. Like your value shares would typically perform during a recovery phase. Then you would have your momentum factor, which would basically outperform during an expansion phase. And this is because you'll find as company earnings start to rise, that would be reflected in the share prices. And during a slowdown, your quality funds would be basically outperform the market as they can weather the downturn better than any other companies. And with low volatility during a contraction, because they don't participate much in the downturn, you'll find that they would outperform over the long period. Now, as an investor, you have this choice of different factors in which you can invest in. So what would be the preferred choice? Obviously, investing in only one factor, one might experience some volatility in between. So the next option would be to invest in a multi-factor approach. Now, with a multi-factor approach, it's basically looking at creating a portfolio which has characteristics of momentum, value, quality. Now, there could be other factors as well. And the benefit of this is that your investment profile will be much more smoother over your investment horizon. Now, in terms of the construct of a multi-factor portfolio, there are different ways in which one can construct this portfolio. Firstly, you can invest in single-factor portfolios and also manage the weights according to your own investment profile or your risk profile. The other way in terms of constructing a multi-factor fund is from a bottom-up approach. So you would basically choose shares which have the qualities of maybe momentum, value, low volatility, etc. And you could construct a multi-factor fund in that way. However, with both constructs, you get the same result in that your investment return over the long-term horizon is much more smoother compared to investing in a single-factor fund. Now, has there been demand for the multi-factor approach? So, sure.
Can you please go back to the previous slide with the graph? Yes. Now, as a fund, how do you, because obviously that is more cyclical. So as a fund, when you're doing a manager research or market exercise where you want to select certain managers, at what phase would you then looking at that, would you say you want a particular manager? Because you now you're talking about styles and based on what the fund wants to achieve at that point. Are you saying that at any given point you might find that most funds will be overweight on value or quality managers than any other manager because of the period that we're in now? Are we currently with COVID, I mean, are we in between recovery or slowdown? Or are we in the contraction part?
Okay, so if I understand you correctly, is this an economic sort of question that you're trying to get across?
Yes, in terms of how should trustees then begin to understand how and when to then select a manager, and what kind of a manager would be that for the fund?
Okay, so I hope I answer your question as you would prefer, but this is what I spoke about earlier in terms of firstly diversification. Now, one can't say with guaranteed certainty that because I'm in this investment cycle, this is exactly how this fund is going to perform, etc. So for that reason, you have firstly your diversification towards smart beta products, and then within that, you can use a multi-factor approach. So during any economic cycle, what you'll find is looking at the multi-factor approach, even though there might be you might be in a slowdown, because you have factors that are part of your multi-factor portfolio, like low volatility and value, or momentum for that matter. The combined return of those four factors would basically smooth your return over time. So because as an investor, you don't want to be selling out at the wrong time. And normal investor behavior would be the market is turning down and then you find people selling out of the market. Now, the way to sort of get past that is to reduce your risk and by basically reducing your volatility. So you don't have to concentrate, the market is going to turn down, I need to sell out and maybe switch to another factor. So I hope that answers your question.
And there's another point which you made reference to. Normally, there's a saying that you don't time the market, and also in investment terms, past performance does not determine future performance. But there was a statement that you made earlier on that says, I think you were describing one of the styles to say, if that portfolio or asset was performing well in the past, chances are it will continue to do so.
Okay, so yes, no, definitely past performance is no indication. Without doubt, even if I will come to our performance of the funds that we have started in April of 2017 as well, and I will go through that performance. But at the end of the day, you're not going to get any guaranteed performance from any portfolio manager for that matter. As long as an investor, what you need to look at is basically, firstly, what is the investment objective and what is the risk profile? And those factors need to actually come into your investment strategy. And that's what you need to look at. Thank you. Okay, so as I mentioned, the growth of the multi-factor funds are growing quite well. In 2008, there were around 37 multi-factor funds out there. However, 10 years later, that had grown to around 450 multi-factor funds. Now, in terms of assets under management, in 2008, the assets under management was around $2.5 billion. However, in 2018, assets under management in the multi-factor space had gone up to around $74 billion. So you can see within smart beta space, within the factors, within the multi-factor approach as well, how the demand has been picking up towards this product. Now, also in terms of retirement funds, there was a survey done by Create Research, and they surveyed 127 retirement fund managers in 20 countries. And what they found was that retirement fund managers are constantly looking for alternative ways to invest without the high volatility and get the benefit of alpha. Now, they also found that recently, more and more pension fund managers are starting to invest towards a smart beta strategy. And then looking at statistica.com, you'll find that the research is that the global pension fund industry is around $51 trillion. Now, as pension fund managers start taking a liking towards a smart beta approach, even if it's just a small percentage, you can see that this type of a strategy or product has quite a lot of room to grow still. Now, I was speaking about performance earlier. So we at Momentum Asset Management, we launched in April 2017 two smart beta products. The first is the Momentum Equity Fund. And this is the return that you can see since inception. Now, as you rightly said, sir, it's that past performance is no indication of future performance. However, This is a return that one would have gotten from investing in the momentum trending equity fund. Now, besides the return, what one also needs to keep in mind is that had part of your investment been allocated towards such a product, you would have firstly gotten the benefit of diversification. And then thirdly, if you look at the fees on this fund compared to an actively managed fund, the fees are much lower compared to an active fund. And then this is the value equity fund that we launched, also April 2017, and it's a similar story. It's a good return. However, you still get the benefit of paying lower fees and the diversification benefit. So these are the single factor funds that we at Momentum Asset Management have, that are basically has a long period of history which we can show performance on. Then let's look at the multi-factor approach. Now, what I did was to look at on research affiliates, just to construct a multi-factor fund and see how that fund has performed relative to single factor funds. Now, the way this multi-factor fund was created, basically using value, quality, and low volatility as single fund investments. And the allocation to those three factors was equally weighted. Now, looking at the performance, this is based on the US market. Now, if you look at the performance of the multi-factor fund, you can clearly see the volatility of this fund is much less compared to had you invested in a single factor portfolio. Now, this brings me to fees, because fees is quite a hot topic as well. Now, in terms of Morningstar's annual fee study, they did a study in terms of the fees that between active funds, smart beta, and passive funds. Now, with regards to the way the study was conducted, this is not an average fee that they used, because obviously you can have a portfolio manager managing $10 billion and he's been charging maybe a 2% fee, and then you have a $100 billion fund charging a 1% fee. So to take that skew out of the market, they've done a weighted average approach. So it's basically your total assets under management versus your total fees paid. Now, you can see where smart beta fits in. It's basically quite lower compared to your actively managed funds and only slightly higher compared to your passive funds. Now, the question is, does fees actually attract inflows? So on the same study, you can see that 20% of the cheapest funds basically attracted over roughly $50 billion of assets, while the rest of the market experienced outflows. And then within that, if you look at the cheapest 20%, from there, the cheapest 5% attracted 90% of the inflows. So that clearly shows that in terms of fees, the demand for lower fees are actually quite important, and that's what investors want. Now you ask yourself, why is that? I mean, obviously investors want to pay a lower fee, but the important thing to keep in mind is that it's not only paying a higher fee and having your investment drop by that value, but what would have been the impact had that money been invested into your portfolio? And that can also, depending on what the fee is, it can add quite a bit of value to your investment. So with regards to how smart is smart beta, firstly, it can lower your risk from a diversification perspective, and not only diversification to smart beta, but within smart beta, you also have the multi-factor approach. You're also paying lower fees for your investments, and then on top of that, you have the potential to outperform the benchmark. So all in all, I mean, a good investment strategy, which I think still has more time to grow in the market. Thank you. Any? Sure.
I've got one or two questions on the. Thanks very much. Thank you. Your method, first of all, yeah, let's just look at the smart beta. You gave examples of it being, I think, 21% of the ETF market in America. And in South Africa, smart beta is about 3% of the ETF market in South Africa. And it's been around for a while in South Africa. First of all, why do you think the take-up has been so much less in South Africa than in America, for instance?
Okay, so basically within South Africa, the reasons. And first, looking at our market, the GSE, in terms of the size of the market and in terms of your liquidity out there, you know, having a large fund and basically wanting to create a smart beta portfolio, your chances of, you know, you have much more less room to move compared to the US market. Now, I mean, just as an example, if within a smart beta space, or any space for that matter, in terms of unit trust, you would have to, in terms of your weightings per share, you would have to have a much higher weighting per share compared to what had you invested in the US market. So that could be one of the reasons that could constrain or portfolio managers from saying, before we create this market, or even for investors, before we invest in this market, let's look at other options out there in terms of globally.
Okay, that leads on to another question, which is that when you're constructing smart beta, it almost looks as though the South African universe of shares is so small. There's only 60 or 70 liquid shares.
Yes.
And so when you start using factor criteria to put together portfolios, they're not particularly different to a straight market cap or equally weighted or whatever else type of portfolio you'll have in South Africa, because you're really just picking the same shares with a slightly different weighting. And so therefore there may be more scope to implement smart beta in a global context, and particularly in America. And so that then leads to the question, why hasn't somebody like Momentum brought in more smart beta products and made them available to the South African market that track global rather than South African indices?
I think if you look at your different investment platforms out there, the opportunity is there to invest in global smart beta funds, if one needs to do that. So, I mean, if you just have to look at some of the websites like ETF.com, for example, there are places where maybe it's not that much, I don't use the word advertised or made known, but the platforms are there, and one can invest in a smart beta offshore unit trust if one needs to do that.
No, I suppose you're correct, but there must be a market for listing a smart beta multi-factor ETF on the JSE or something like that, and just to make it available to the general public. Is that something that should be considered?
Yeah, no, definitely. I mean, it will basically just give investors more choice. And obviously, like you mentioned, because of the liquidity issues on the South African market, having more choice in terms of offshore markets, it will basically be better for the investors in terms of investment choice.
And then coming back to those factors, you had that very nice graph showing, depending where you are in the cycle, whether you should be in value or momentum or quality. And I think that therefore introduces for a lot of investors and for a board of trustees or a retirement fund, we need to know where we are in the cycle.
Sure.
And then we then have to go and buy that factor. And then at some stage we sell that factor and we buy another factor. So we keep on changing our smart beta approach. And that therefore possibly makes a multi-factor beta, smart beta product more interesting. And I'm interested that Momentum hasn't introduced that sort of product to the South African market, or not yet.
I would say not yet. So, I mean, 2017 is not a long time ago when we started our first smart beta unit trust. And as I mentioned, in April this year, we launched the quality unit trust. So obviously, depending on demand appetite and research and things like that, like I say, it's not yet that we've had a multi-factor fund or multi-factor unit trust, but it's not to say that we won't basically launch one.
And would you rank other types of factors? Would you look at things like dividends and size and whatever have you? There's some people say there's more than 4 factors. There might be other investment factors.
There's definitely far more than the 4 factors that I mentioned. So in terms of the top 5, it's basically your momentum, value, quality, low volatility, and then size as well. So those are the 5 most common ones. However, there are many other factors out there, so, but these are the most common. Okay. Okay, thanks for your time. Appreciate it.